What's your outlook for US interest rates? Do you see Federal Reserve raising rates at any point during calendar year 2026?
Right. So, Sonal, I think there is a little bit of a change in what we would call the expectations of central bank actions, and that's visible in this chart over here. This is a chart of central bank rate hikes minus the cuts on a 3-month rolling basis, and it includes both developed and emerging markets. And what you can see is that this chart, which was in a rate cut territory, is now actually moved to the baseline, which means more central banks are now indicating possibility of hikes as opposed to cuts. As far as the US Federal Reserve is concerned, the market now expects the US Federal Reserve to actually to increase rates in CY26. So at the beginning of 2026 in January, the markets actually believed that the Fed might cut one or two times during 2026. But as we speak today, the markets now expect that the US Federal Reserve may deliver one rate hike of 25 bips in the current year. Why might they do this? One, inflation is continuing to remain way above their comfort zone. Remember, their target is 2%. Inflation by all measures is running above that level. Some of the chip-based inflation continues to feed into their system, and supply disruptions as well have caused their inflation to be higher. So this is something which is a reversal in trend where we started 2026 thinking about rate cuts, but now we are expecting more of rate hikes rather than rate cuts. I'll also add over here that I think we also have to look at the regime change which has happened in the US Federal Reserve. We now have a new chairman, which is the Warsh as the new chairman of the Federal Reserve. And his own thought process appears to suggest that one, he's a lot more of an inflation hawk based on his previous comments, though he actually believes that AI-induced productivity gains may cause inflation to be weak or remain low. But his bigger points of view relate to the fact that he does not believe in spoon feeding communication to the markets. In fact, his belief is that maybe they are over communicating and markets should behave more like grown-ups and not require constant guidance from the central bank. The second point on which he tends to differ from what has been the de facto system for, I would say, the last 2 decades is that he's also not in favor of the Fed increasing the size of its balance sheet. He feels the central bank's main instrument should be rate changes and not its balance sheet. Now, when you think about lesser guidance, when you think about more usage of rates and less usage of balance sheet, that would essentially mean more volatility in rates, and that would also perhaps lead to a higher risk premium or term premium in the rates. All of this, I think, is changing the expectation, particularly in terms of the US Federal Reserve policy. But we can also move to the next slide, Sonal, because I think, do we have one more? Okay, sorry. Yeah, we can move on to the next question.
Yeah. Let's turn our attention to India now. One of the important external variables for Indian economy is crude oil. Crude prices have taken a sharp U-turn and are now back to the pre-conflict levels. What does this mean for India? And in that backdrop, how do you see interest rate outlook for FY 2027?
So, Sonal, we are seeing a big divergence play out over here. Now, what you are seeing in this slide is India interest rates, and what we are looking at is the India interest rates over the last, effectively, I would say this is a 3-month odd period, and you can see what the change in yields has been over this period. Essentially, all the yields in India have trended to go lower over this period. And therefore, this is very different from the pattern that we saw in the US, where in the US actually yields have tended to move higher because there have been concerns about what happens to US Federal Reserve policy. And remember, their inflation has stayed above the comfort zone. Whereas in India, be it treasury bills, be it certificate of deposit, be it government bonds, be it corporate bonds, in all cases, the yields have come down on average about 20 basis points. Whereas in the US, actually, yields have not cooled down too much. In fact, if you look at the US government bond yields today as compared to 3 months ago, the yields have actually moved higher. This is very different as compared to India, where you can see across the board, government bond yields have actually dropped and come down. And we can see elements of this in the next slide as well, which captures this divergence in behavior. Now, what we are looking at this slide is bond yield differentials. So we are looking at the difference in bond yields between the India and US, right? So we are comparing India and US and looking at which way is the differential going. Now, first we need to look at the inflation differential. That's basically this blue line. So you can see the blue line, and over time you can see our gap in terms of inflation is relative to the US is actually coming down. So go back about 15 years, the gap was very high, and increasingly the gap relative to the US is much, much smaller. Now we can convert this into looking at the difference in bond yield. So what is the US bond yield? What is the India bond yield? And you can see even over there, over time, there is a general downward drift which is happening in the bond yield. So the bond yield differential was as high as 6% if you go back in history to 2012, 2013. We are now at some of our tightest yields in terms of the differential between US bonds and India. But the reason this differential is so low is that our inflation differential is also so much lower compared to what it used to be in the past. So yes, bond differentials vis-a-vis the US has come down, but I would argue that this is a function of the inflation differential coming down. And finally, just given the way India has managed to tackle the recent increase in crude prices through a combination of fiscal and other measures, and given that it has so far proved to be temporary, what that means is that India's CPI could remain in the comfort zone. So unlike the US, where markets are now discounting a rate increase, in India, the base case remains that the central bank will not have to increase rates, and the rate differential looks comfortable, even though it is much lower than its historical track record, but that is in line with the decrease in the inflation differential.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.